Hello and welcome to another ACY Securities podcast. My name is Alistair Schultz and I'm the Chief Market Analyst for ACY Securities, and today I'm also your host for today's podcasting episode. And in the studio I'm joined by Daniel Weiner. He is the Head of Growth Strategy at Raiz Invest, a publicly listed ASX company, and as well as that, he is a veteran trader of varying markets who is today in to talk to us about oil, markets on inflation, NFTs, and of course about the bullish mantra and what's different about it now. So first of all, thank you, Daniel, for joining us in the studio today. It's a pleasure to have you here. And as well, it's actually quite exciting for me to be on the other side of the interview for a change. So thanks again for coming in.
Well, it's great to see you in the flesh. I'll say, yeah, it was an interesting 2020 in all regards. I guess that brief stint at AusBiz did really open my eyes to the interview process, and I feel really privileged to join you in the studio.
It's certainly a bit of a mind trip for myself, being that we're almost always on the other side of the desk, and now we're on the same side. It's very much exciting. So to sort of get us started off the bat, can you tell me a little bit, and for probably our viewers, about your own career highlights as a bit of a reel for us in the summary, so that we can sort of get a bit of an idea about you and how you trade and how you've traded in the past?
Absolutely. Well, I actually started and spent most of my career in high frequency trading. So I did what many Australians do at the university fairs, sat a lot of entrance exams. I was lucky enough to be accepted to a few firms, including Tibra Capital and Optiva, two quite recognised high frequency firms. And I spent a great deal of time with Tibra trading. That was in the options team. So basically joined in 2008, the height of the GFC. So every day was a lesson. There was a lot of profits and losses flowing around. Basically, you would learn on your feet. You would learn very quickly when things were moving that fast. And I covered Hong Kong markets, the Japan market. This was during the time of the earthquake into 2012. We were covering Japan. So the sort of things I've seen over my career just in 10 plus years.
So what actually sort of, with your career origins, obviously you've started some time ago before in the GFC sort of area. You've dealt mostly with options. What actually got you into it all?
Well, look, I've had a fascination with numbers all my life. I really covered finance heavily when I was at university, and ultimately anything which involves comparing numbers, contrasting numbers, seeing patterns, that was particularly interesting to me. So trading already grabbed me. When you'd see it in the news every day, you would see these numbers moving up and down, trying to just even decipher what it meant from quite a young age. Growing up in Sydney, there was the centre, the MLC centre, which would have the ASX 200 number every time you drive past, and just trying to work out what makes this number even move.
So it's almost like there's been some sort of subliminal messaging going on every time you drive past this place.
Sitting in probably the child's seat, just looking up at this number, trying to work out what's actually going on. But fast forward, ultimately spent a lot of my career in front of a lot of big screens with a lot of flashing numbers. Probably a lot less yelling on the high frequency side. There's a lot of sound effects of trades happening, doing thousands of trades a day. Just a huge amount of parameters to control and move and interpolate, but really just drama every day during 2008 especially.
And so when it came to your high frequency sort of trading, I mean, from my experiences with high frequency trading, it's almost always been automated to some degree with either AI robots or expert advisors that are being used in some form of trader's assistant, is the way I like to look at them. Is that kind of the sort of realm that it was with that?
Already in 2008, it was changing a great deal from what I've heard from people who had been heavily in the industry from where it was, say, 10 years before. There was still a lot of human interaction at that point in time, but a huge amount of parameterization would control a lot of the trading. If you fast forward now, there'd be almost no hand-to-computer full stop across any of the major high-frequency firms. There'd be a lot of data analysis after the fact, a lot of interpolation on the back end, but nothing that would actually really immediately impact a parameter change, because all of that is, as you say, machine learning, interpolated, regression tested.
And that's the same sort of experience as I've had. I mean, even to today, if I am going to be using any automated sort of software for my own trading, it's always as an assistant. It's not something that you need the human intervention or the human observation to really occur in them. And I still operate that way. I suppose maybe that's now the old school, but back then that was new school, right?
Definitely.
So that kind of gives us a little bit of an area to sort of focus on a bit later. But what's sort of, where are you now? Obviously you're still trading, you're perhaps doing algorithmic stuff. What sort of trading are you doing today?
Yeah, so I guess fast forward, I've moved away from the high frequency trading, still trading every other day for my own account, but now I've actually moved to the other side because I've always had an interest in helping people with their finances, not necessarily always on the day trading side, but whether it be friends or family, I just always had a natural interest in helping people get the most out of their finances, understand what they were doing, where they were going. And having moved back to Australia after trading in London for about 4 years, I've really continued with that passion, and now I've taken a growth strategy at Raiz Invest where effectively anyone can save and invest from as little as $5. So really what we've got at Raiz is a community of people who might have just accessed markets for the first time, or they might actually be quite sophisticated long-term investors who are just looking for a really easy to use platform with low cost competitive fees to access markets and build a portfolio.
So you're now kind of working in a space where whilst you're still trading on your own accounts, you're also doing sort of financial literacy style stuff with Raiz. And I suppose as well looking into the idea of trading evolution, which would be cool to sort of understand. You've started as an algorithmic trader, you're still trading as an intraday trader. What's changed for you in the last 10, 15 years of trading that you've conducted? Obviously, you would have started somewhere with the algorithmic side and high frequency stuff, and now it's a little bit different, I'm assuming?
Well, particularly different if you're a sole trader. And it doesn't matter if you've come from the high frequency background or not. Ultimately, it's really, really difficult to compete on the small tick trades with the high frequency firms. Yeah. The same goes even for institutional traders. There is just such a huge advantage when it comes to being high frequency, the ability to trade in and out with ease, with low cost, effectively be able to scratch any trade you want, which means that overall your return is going to be incredibly improved because you'll have so many fewer losing trades. When it comes to trading on an individual basis, I generally look for, let's say, a bigger profit margin than half a tick.
Yeah.
So the entire way that you trade, the way that you behave is quite different. And I think, sad to say, I'm sure it's the same with many other traders, my returns on my personal account have never actually been quite as robust as they were on the high frequency account, but I think that comes down more to human behavior than it does to necessarily performance.
I also think it's, there's some element of, I know with my sort of background in trade teams, I've not so much, whilst high frequency stuff was incorporated into a lot of my learning and along those lines, the actual trading styles that we were operating with were in team-led environments with 6 guys. Every day we'd sit down, what are we liking today? And the discussion would go around that way. And even just in that sort of circle, when you've got a team, you've got 6 different brains coming up with different ideas about why they do or don't like a certain thing. And your performance is just generally better because you've got more options. It's almost like chucking a whole heap of uncut stones into a washing machine, hitting on, and then pulling out, refined pieces of stones that look like they've come out of a lake bed or a river bed where they're all nice and smooth. You get that much smoother idea generation for actually picking out your trades for the day or even for the week. And I suppose I'm a bit more longer term than the high frequency. Of course, I've done high frequency taking sort of in the 2,000 to 3,000 trades per day. But for me, I've always been time poor, and the idea of looking at long-term stuff has always worked out quite well for me. So, I mean, I suppose in that sense, regardless of what area you're actually investing in and how you actually invest, it seems to be the common theme is that, if you're trading on your own, you don't tend to have as consistent or as good returns as what you would working in a high frequency team or a generalized trading team that looks at a variety of markets. So do your thoughts sort of align to the same sort of thing?
Well, I think if it comes back to how people choose to look at their trades and the plans they set out, it's just critical to effectively stick to a plan to generate the consistency that you imagine a high frequency firm generating, because there are parameters, there are rules. It means there's less emotion involved and there's some sort of plan or effectively relative value trade taking place. But if I then apply that to the way that I trade by myself, I always make sure before doing a trade to just recheck myself. Is there a particular reason I'm doing this trade? What am I giving? What am I getting? What are the risks? Just by asking myself that question before doing any type of trade just gives me that extra sense of validity, that internal voice which will recheck my own logic. So it's great to have 6 people around the room giving their opinion.
Yep.
Sometimes the internal voice that can count as a +1 on a trade. Just giving yourself that extra pause. What is the reason for doing this trade? Why am I doing it? Sort of that validity.
Does it follow the line of sensing or logics that are required for it?
Because I think with trading as well, not clicking the button is much harder. Well, I should say rather the restraint of not trading and waiting for the level that you want or sticking to the plan that you've set out for yourself it's much more difficult than pulling the trigger.
I've always found myself in the same sort of scenarios, and I like to think of myself, I'm sitting on my hands, it just means I'm neutral in the market and I'm still in a position. So that's the best way to sort of think about it.
You're choosing to, at that moment in time, not do anything.
That's right.
Yeah.
So in terms of, obviously with so many trades that you've had over the years, with from high frequency to what you're doing now, what's your best trade and what's your worst trade?
Well, I would say maybe on the best trade side, I'll go back to the high frequency days. We would sort of have an ability to check the dividend pricing, especially in the options market, and we became very good at pricing around dividend date risk, dividend amount risk, and that's obviously a key feature of option pricing and call options. So you could make a great deal of money by building strategic positions, and that really came back to the whole having a plan, pricing models, checking what you could make and could lose in various scenarios, and just building really good statistical positions, which effectively was how I carved the majority of my trading career. So that would be from the actual firm side. If I look at worst trades, I'll go to my retail account, unfortunately. Look, there are some good trades in the retail account, but I think the worst trades are always cutting my wins too early. And I guess that comes from the relative value trading. If you're doing so many trades and they're all worth a fraction of a tick, suddenly 10 or 20% looks like a really good return on your retail account. Maybe not so much in 2020, 2021, but when 10 or 20% meant something in a couple of weeks, I would generally take that profit, put it into something else. But now I look at those positions, they're up 10, 20, 30 times, and I think I cut those things way too early. So
that also is another problem that traders have. It's either getting married to the position when it's in the wrong direction, or cutting it out and bailing too early when it could potentially go much further. I'm
a prime offender when it comes to that on my account. And then I would say my other worst trade has been being a no-coiner. I'm not ashamed to say it, because I still have a fundamental issue with exactly where all the coins trade, but as it stands, a no-coiner.
Well, I mean, I would wish to change that for you, but I certainly, whilst I've had cryptocurrencies and I've certainly got stories about them, I in this day and age, I still can't see, where exactly, and the same answer always comes up, the same questions always get asked. What happens if the world was to fall to pieces tomorrow? What is the value of whatever it is that we're investing in? And whenever we look at fiat money or cryptocurrencies, it's generally not the right decision to make, because if it is to fall, then at least the paper I can wipe my bum with. But the other side, like with a crypto coin, what am I going to do with that? I can't do too much. And I suppose this is probably where Ray Dalio gets his perspective of cash is trash. That same sort of effect. If you can get a yield or a return out of it, other than just a speculative asset, I would rather go for that sort of direction. Now, I suppose we should probably move into the idea of the oil market, because there's been a lot going on with oil. We've got, new futures coming up. We have a whole stack of information to sort of think about from last year and process. And of course, now we've seen sort of oil cuts not go through. So in 2020, the saga as it is, what's happened with oil? What's your take on it?
Well, I'm still processing what happened a year ago in the oil market. And if we look, it's been almost 12 months to the day since that fateful meeting in March 2020, when the Saudis and the Russians, they couldn't get an agreement. They both left hot-headed. And less than a month later, COVID had hit full swing, and suddenly you had a demand shock coupled with a supply glut. And it was just a worst case scenario.
And something that we hopefully won't have to see again. But now that we've gone through that sort of idea, I mean, the history of oil from last year, just in the Russia, the Saudis, and the Americans, or whoever may have been involved, that they've seemed to have not actually gone down that path. So in this instance, so where are we sort of sitting now when you think about oil?
Well, now that I still find it hard to believe that oil is trading so much higher than it was now than where it was a year ago. We're talking, almost 50, 60%, maybe even slightly more at this point in time?
Well, I mean, if we were to look at it from a futures market, it was minus $37 at one stage. And now we're up at about, $65 a barrel, maybe $70 a barrel, depending if it's on Brent.
Yeah.
So, that's a much bigger perspective of where it's actually gone.
Well, I guess we look at maybe both the consumption that was used before COVID, which was around about 100 million barrels a day. And then when the demand shock hit, and clearly no one saw this coming, or very few market participants saw this coming. And and we went down towards that 80 million barrels a day, which meant that oil did have a reason to be trading at a heavy discount because ultimately it just wasn't being used. There was no demand there compared to previous years. But if we fast forward now, we're back in those high 90s. We're back to fairly regular consumption, pretty reasonable demand.
We've also got the domestic side picking up in flights going on. So
exactly.
And now there's sort of subsidies getting involved, at least here for Australia. And the US is looking like their domestic travel has slingshotted over the last couple of weeks. So that demand side is certainly starting to pick up. Now that demand is picking up though, what's too expensive when it comes to a barrel of oil? At what point do we sort of go, hey, we're not paying that? Because if we get back up to the $90, $100 a barrels like we saw back not long after the 2008 sort of era, it leaves us in a very interesting scenario yet again.
Well, every year we move forward, we get closer to EVs really trying to cut in on oil. And we're seeing all these sales across North America, in China, in Europe. Those sales are increasing year on year. Those percentages are huge. And
VW is doing really, really well with that EV model because they've basically, copied the Tesla model in terms of, how we do presentations and all of those sort of things.
Just no techno king.
No techno king, but maybe we should talk to the techno Viking and see what his thoughts are about that. But in any sense, that movement is exactly right. We are moving away from it. We've already got restrictions in place that are going to prevent combustion engines from being produced after a certain date. So do we at what stage should we sort of start considering oil to perhaps not be as valuable to us anymore? Here in Australia, it's a bit different because we don't see the EVs on the road, but I'm sure in the UK and in other parts around the globe where there is a little bit easier to actually have access to rechargeable vehicles, that it's going to make a difference at some stage.
It will, but I mean, this is the beauty of a cartel setup.
Yeah.
This is precisely when you want to be able to control the output when you want to. Not just because you're having a petulant fight over politics, over them cutting, them cheating on their cuts, who said what. This is the point in time where if the oil industry wants to take a look at itself and realize this could be the last chance that oil has this prolonged uptick before all these external pressures come in and kill the party. They don't want to be the own cause of their own destruction at this point in time. It's been done before.
They've already come very close to it last time, right?
And in 2014 as well, it was trying to cut the shale industry in its prime in the US, these over-leveraged players. If the oil could get pushed back down below $40, it was going to wipe out basically the entire industry. It got very close to happening. Then seemingly the recovery, everything was moderately okay again. And then just one political spat at the wrong time in 2020, again, almost brought some oil players to their knees.
So if we end up with that sort of, shock jock that sort of happened, obviously it wasn't received very well last time. We've just had a instance of, the option for them to increase output. And they've all decidedly, or at least from the OPEC standpoint and the cartel, they've shut that down. And interestingly enough, Saudi Arabia's decided to continue with, 1 million barrels per day in a voluntary cut. So, obviously at some stage that voluntary cut has to go. And at some stage, we have to see the other members wanting to increase their production because this is their livelihood for a lot of these countries. They are commodity-driven countries. They are exporting oil. The less they export, the less they make and the less they are really going to have in terms of room for play in the future. So wouldn't it be within their interest to be trying to sell as much oil as they can rather than selling it for as much value per barrel than they can?
I think it comes back to where they think oil might settle in the future. So if it doesn't have this prolonged spike, if it has this downward pressure for the coming decade, they don't want to be the reason to spike it down in one go and then not give it any room to recover. They'll give it at least, in my opinion, a couple of years or a few years. We might even see more prolonged cuts just because they understand how fragile this price really could be in the medium term. If you're not the only thing controlling the outcome, if you're not in control of your own destiny, you've got to factor in these other outside forces now. It used to be all talk about EV. There were rumors decades ago that intellectual property was effectively being bought to slow down that progress. There's no slowing down that progress now. We know that will be up and coming. Mandates are in place. Green energy, there's just so many other ways that the world can move.
They've now got, not only from, the financing side, that's a problem for them in terms of banking regulations taking the ESG approach and not wanting to deal with fossil fuel companies. They've got EVs, they've got, a variety of other things, but I suppose EVs still have their own challenges.
Absolutely. Until we see the logistics and the various sort of, technology in place to allow people to drive from point A to point B. I mean, we saw it in Texas with the power outages. People couldn't charge their Teslas.
They couldn't.
Who would have thought that effectively like a major sort of thunderstorm event and floods and a series of sort of outages, or a snowstorm, I should say, frozen floods, would lead to people not being able to charge their car.
Well, I mean, I suppose even from the way that the combustion engine has been overtaken by EVs, there still stands that possibility for a better technology to arrive during the height of Tesla value, and we end up with another combustion engine that runs off hydrogen or a nuclear-powered car, which is probably not the best move to go with.
I will not be the first person to jump in that car.
Look, I'll give it a go. But in that sort of essence, there's still something certainly available that could, or not available, but certainly has the potential to become available in some time down the track. So maybe EVs aren't where it ends, but perhaps oil's time, they know, is certainly limited for the time being.
And with all these new special purpose acquisition companies, you would see a lot more money flowing directly into these, innovative future vision ideas than you ever would have before.
Yes, yeah, definitely. Well, so I suppose we've had a bit of a talk about oil for a little bit now. I would like to get a bit more of an idea on Raiz, and more specifically on financial literacy and financial well-being. I suppose it would be important for some of our viewers, but also anyone who's going to be paying attention to sort of your stuff and what happens at Raiz as well. How important are both those elements, the financial literacy component and the financial wellness, not only for a person who might be wanting to invest, but just in general public as well?
Financial literacy is incredibly important. We saw in 2020, especially during the market volatility, just how much demand there was, not only from Australians, but around the world, to really understand what was going on financially, how it was going to affect their future, and just really craving that sort of knowledge and understanding. And so Raiz has always understood the need and the desire for financial literacy, and Raiz has always made a focus, and one of its goals is to continue to provide its customers and potentially just people within the community with as much access to financial literacy as possible. There are often paywalls associated with financial information, so that's always been a natural limitation to people being able to access information. But really the trick is with finance is you want to put everything in simple terms. You don't want to patronize anyone, you don't want to exclude anyone. You really want everything to be easily digestible, interesting, and relevant. Okay. And that's really the challenge when it comes to financial information and how it's consumed. And so when you're looking at a new young millennial group of potentially first-time investors, or even people who aren't millennials, but it's their first look into the market, they're just trying to understand a little more. It's about providing them that information in a really easy to understand way, hopefully slightly entertaining, but you want them to leave with something as a value add. Even if it's just one thought, one idea, you want them to just have that. And that adds confidence, which over time can add into being able to have the confidence to make an investment or the confidence to make some sort of financial action that's in their favor. And that's exactly what education and financial literacy really aims to do.
So it's all about really making sure that everyone has an equal opportunity to really understand the financial metrics that we are both privy to because of our background in education or wherever else it may actually have come from. For a lot of the people out there, they may not actually have this. So I think it's a fantastic sort of way of actually targeting and speaking to people in a much more relatable way. Now, I suppose with Raiz, you guys sort of tell me a little bit about how it works. There is obviously a micro strategy side to the investing that's going on. You're doing it in fractional amounts as opposed to full lot sizes and the like, and full contracts. Is that the idea?
That's exactly right. And both from the financial literacy where it should be open to everyone, investing should be open to everyone as well. And the beauty of micro investing is it allows anyone of any size trade to have access to markets, to the same products, the same ETFs, and even to Bitcoin, which we have at Raiz. So effectively, anyone can save and invest at Raiz with as little as $5, and that gets distributed in an allocation into a portfolio for a customer. And effectively, the customer has many different ways over time to continue saving and investing. And there are some really handy features that Raiz has, including Australia's only ability to round up, which effectively means every time you're spending on your credit card or your linked spending account, every time you buy a coffee, your lunch, your transport, the roundup effectively automatically flows into your investment portfolio. And that's just a huge help to people who have a limited understanding or limited access to markets, because what it does, it creates that habit happening in the background, which allows them to continue adding to their investment. And we've had just so much positive feedback from customers where they can't believe that they've managed to save and invest $1,000, several $1,000s in the course of the year. These are people who had never accessed markets, who had never really understood the power and the importance of having a saving and investment journey.
It sounds like one of those sort of advantages that I could take to the pub with me, and I can be investing while I'm having a beer at the same time, and without even noticing. Like, I do love that idea. Now, in terms of some of the portfolios and the strategies that come from it, does that get done by Raiz, or is that done by individuals? Do they have to be picking their own thing? Because that's, I suppose, for a lot of traders, that's one of those hard things. Like, how do you diversify right? What's the right way to be going about it?
Exactly. So we have the beauty at Raiz of having both at the availability of customers. There are 7 portfolios from Raiz's side, and they range from conservative all the way through to aggressive. And there's also an environmentally or socially responsible portfolio called Emerald, as well as a portfolio which contains 5% of Bitcoin called Sapphire. But just this year in January, Raiz has released a custom portfolio, and what that's really aiming to do is it's aimed to give people who are a bit further along their investment journey, as well as sophisticated investors who might want that control and that freedom to allocate as they see fit, the ability to allocate between 14 ETFs and Bitcoin in whatever percentage they like, just with a maximum 5% in Bitcoin. But what that really means is it caters to this broad use group, because investing is for everyone, but everyone's got a different investing path. Everyone's got a different risk tolerance and potentially a different understanding of the products they're using. So really, it's this flexibility and this toolkit which allows a wide group of people to make these savings and investments.
So how come there's a limit on the Bitcoin side of things? Because I'm sure there are going to be some people out there who be like, I just want Bitcoin now.
That's very true. Look, you may have to speak to ASIC on that front, but from a retail
sort of point of view,
portfolio composition, it was decreed an appropriate number. That number can potentially get larger than 5%, but there's a band where auto rebalancing takes place, and that occurs over all portfolios as well. What that means is, as I'm sure many of your clients would know, when your winners are doing well, they'll probably get sold down a bit, and the ones that are performing not as well generally bought up a bit more. That's your typical dollar cost averaging, building a robust portfolio over time. And with most of our portfolios, they do have a recommended duration of anywhere between 2 and 5 years. That's not to say people can't move their money in and take it out as often as they like. That's the beauty and flexibility of Raiz. But just if people are looking with a long lens of the market, that's the right sort of time frame to look at it if you're looking to really, look at those returns and get some sense out of them.
Okay, that's good. I like that idea. I mean, I think Raiz is one of those things that, most people could certainly take advantage of, and if not, certainly someone like my grandmother who's got no idea what they're doing, I should be offering her a package and suite about how to do it. Now, in 2020, moving on from sort of Raiz, I want to sort of have a look at sort of 2020 in a bit of a nutshell, and we sort of, the idea of discussing, and what we sort of said at the beginning of this, was that we're going to have a look at this bullish mantra that we've all been using throughout 2020. Now, you said to me not too long ago about the idea of people being perma bears, but we're still buying, and it's kind of
the perma bears are buying.
Yeah, and it was kind of like all through 2020, it was like the perma bears keep on buying, and the values don't matter. It's like a really bad edition of Whose Line Is It Anyway? So what do you see that's gone on, and is that still the case today? How has it changed from what we were seeing in 2020 to what we're sort of experiencing now?
I think all we've seen now is the Fed puts effectively move from about 2,100, 2,200 all the way to, must be touching close to 4,000 now, at least based on the S&P. I think at the end of the day, it's been the Fed's hand that has really driven these markets ever higher. It's the trillions of stimulus that have come from the US, from Europe, billions from Australia, exactly. We're part of this situation as well. And what it's effectively done is it's just made it really difficult for markets to fall, because every time that there might be a fall, and we've seen a few recently, a few corrections, the Fed, the other central banks, they're able to step in, they're able to dictate where these yields go, they're able to buy the bonds that they want to buy, they're able to buy pretty much any financial asset that they want. And that is really just providing this perpetual cushion, which I shouldn't be complaining about from a market point of view, but the market is feeling somewhat distorted when there's just trillions and trillions of dollars floating around now.
I couldn't agree more. I mean, it almost, to me, it reminds me of kind of like a helium balloon. You know, you can have that helium balloon, and the more you keep putting helium into that balloon, it'll keep going up. It'll come back down, you put a bit more in. But eventually, you know, gravity continues to take over and brings it back down. And at some stage, that rubber gets so stretched in the balloon, it eventually collapses in on itself. So, you know, I suppose that's probably the perfect analogy for a bubble. Do you
didn't want to say burst, though.
I didn't want to say burst or bubble, but I'm going to anyway. Do you think it's bubble?
It feels somewhat like a bubble, but it doesn't feel like a bubble that's necessarily going to burst. That's the key difference. And when you're the Fed or you're the ECB or you're the RBA, and you can write the rules, and you can control the money, and you can control the printer, it's a pretty unique situation. It might have always been the situation, especially when you look at it from the Fed side. The Fed's there to avoid any sort of systematic risk.
Yeah.
And then it really comes down to a question of, is COVID a systematic risk, or was it just a one-off crazy event, once in 100-year event? And it comes down to how they then approach that set of problems. Because if it wasn't a systematic risk, then there's no need to be pumping trillions and trillions more money in. Leave it as it is now. There's been a huge amount of support. Now let the markets do what they need to do. Let them perform in their own natural state.
Well, I mean, that's exactly right. I mean, taking the natural state away from itself, I mean, I suppose a lot of economics professors over the last year would have been wanting to throw the books that they had written at the wall and be like, I know nothing. But, you know, the reality is that, you know, that's still, the functioning of a market is still going to remain the same. It's just that there is right now a little bit of cloudy water in place, because of how much stimulus is actually going into the economy. So, you know, it does beg the question, when stimulus actually ends, you know, how are we going to respond? Are we going to be having taper tantrums like we've seen so many times before?
Well, it's a question now, is it going to be a taper tantrum, or is it going to be the interest rate move that's going to change the dial on these markets? I think that's really what market participants are waiting to see. Which one happens, and which one might have the loudest pronounced sort of wide effect on the market. My money personally is on a slight move in yield curve, a slight move, just to test the water of how much the market might actually take some heat on an increase in interest rates, because we've seen such a big move in the yield curve in the past few weeks, especially on the 10-year level across the world.
And the interesting thing about the yields, especially when it comes to the yield curve control side of things, like if you look at the Australian and the Japanese example, they're both polar opposites. You know, we've got here in Australia, we're targeting 3-year yields, whilst in Japan, we're targeting 10-year yields. And when you look at the curves, they literally sit like opposite ends of the spectrum, because there's one side targeting that shows a fade, whilst the other one shows growth on the longer end. So whilst there is, examples, there's no exact criteria for anyone that's sort of been in this sort of scenario before. And the amount of stimulus that's gone out is just beyond anything we saw in 2007, 2008 range. You know, obviously the changes that we made back during the dot-com bubble are totally different again. So it's almost like every single time we come into these sort of parameters, it's understandable as to why the Fed and central banks in general are kind of looking at it going, oh dear.
Oh dear would be the understatement.
I'm pretty sure Fed Powell would have woken up one morning and been like, oh no, not again. Why is it whilst I'm in term? He would have been hoping Ben Bernanke would have been able to deal with it the first time.
Has anyone pardoned our debt this evening? No, still 29 trillion and counting.
I mean, with all the stimulus, does the debt even matter anymore?
I guess that's the real question as well, because capitalism has taken a slightly different form now, and currencies, they could get devalued. That's why there's been such a huge run to cryptocurrencies, and that's why I can't necessarily suggest that the prices they're trading aren't fair, because they've been effectively the lotto ticket winners of COVID. No change in business principle, no change in asset. but just a huge flight to safety away from currency.
Yeah.
The more that gets printed, the less people seem to really want to hold it.
I mean, at the same time, I mean, the concern from that element would be that with cryptocurrencies, because, I suppose other than perhaps Ethereum, which has a limitless supply, things like Bitcoin, where they are a limited supply, mean that you get, what you would get the pricing in today with very difficulties in actually being able to adjust the prices. And that's the entire concept of a central bank at its core. So if you were to take away that element of being able to actually control pricing, how can we actually fix that scenario? It's not something that's readily available overnight. It means that if you were to use it as a global currency, you're not going to find the benefit that we would have from using something like the US dollar or a mixed bag of currencies like we can in fiat currencies. And then that way, otherwise we end up, in one instance, it might be we've got Bitcoin now as the global dominant force, as the main currency for the entire world. Does that mean the guy in Venezuela still has to spend like 6,000 Bitcoins to get a cup of coffee?
Jeez, that's an expensive cup of coffee.
Well, but I mean, that's how it sort of looks. If you look at the fiat values of currency in Venezuela, they all end up getting paid in US dollars because the currency has just been, M2 supply to the max.
Yeah.
And, they might earn 6,000 Venezuelan dollars a month, but the cup of coffee is about 6,000 a month as well. So they can't actually buy breakfast after they buy the coffee for a month worth of work. So, in doing that, how can we avoid that sort of a scenario? And no matter which way I look at it from a cryptocurrency capacity, that ability isn't there yet.
Definitely not.
Or at least with Bitcoin, it's not, because of that limitation. That, for some countries, that power, that triple P power is just not going to happen, and your Bergonomics is just going to go out the window.
Well, that's why a change in stimulus, a change in interest rates and the yield curve could really have a pronounced move on some of these crypto prices, because the reality is we're not there yet. Just like we're not there yet with EV cars, there's not enough charging stations. We're not there yet with the cryptos. There's not enough Bitcoins. Everyone seems to want them at the same time. That's had a great effect on its pricing. But if we kind of look at it from the Fed approach and whether or not they'll keep printing money, which might make people move closer to Bitcoin, they've got several aspects in their mandate. They want to maximize employment, but they also want stable asset prices. And it doesn't seem like they're really contributing to stable asset prices with the more money that they're printing.
No, and this, I suppose this brings us sort of back round loop from, going on the mantra about bullish stuff and then to cryptos, but back again, the idea of, when do values actually start to matter again? Because we've seen so much stimulus coming in. And it seems like now we're actually starting to get some questioning of stretched values and people looking at tech stocks and now starting to move into, some of those value stocks that might be considered to be underappreciated. Now, what's your sort of side on that? What do you see as being the scenario?
Well, when I look at value, I look at certain moves. I see many of the indexes trading at their highest ever levels. We've seen, I think, 13 record S&P closes for this year. We see commodity indices or the commodity index really at its record as well. We've got AMC trading at double the price it was before COVID. The US cinemas, which they're still hanging tight.
Are they selling movie tickets yet?
I'm not sure how many people. I think some of them are starting to open. I don't know how many people have attended. I haven't seen the stats, but I see those sort of numbers. That's where the inflation sits at the moment. And that means that even value, to some extent, has been inflated. And then, of course, when you look at tech and everything gets discounted effectively against a number so close to zero that it stretches prices to infinity. Yeah. It's like dividing 0.0001 repeat. And that's why these prices are so incredibly high. So whilst it's difficult to say the prices aren't high at the moment, I still can't find a fundamental reason why they fall too much because of this Fed put again. So it creates this circular reference situation where you're damned if you do, you're damned if you don't. But we're not expecting prices to fall 50% the way they could have in previous non-artificial markets.
Yeah, so we're basically stuck in like a constant loop until we get some sort of action coming from the Fed that actually solidifies we're either reducing bond purchases or we're increasing rates or we are going to take some other form of action that's going to impede your ability to really recognize where the value actually is. Or maybe they'll just go more stimulus. But who knows? Who knows? In which case that could be the different way to go. Now, I mean, I suppose in that sort of idea of value, I mean, where do you see, I mean, we're already seeing inflation in asset pricing in stock markets. Where do you think the next place is? Do you look at it as being part of the CPI basket, or would you look at it being more classed as commodities?
I think commodities personally, that's at least where I'm banking on when I'm doing some of my personal investments. I just can't see a situation where if the yield curve is where it is at the moment, we're expecting, whether that's from stimulus, whether that's from optimism, it really shouldn't matter, because if the yield curve is effectively higher than the, or I should rather say the inflation's higher than what the interest rates that you can find are out there, then you're expecting that negative real interest rate to continue at least for some time. I imagine for the next few years personally. And while that's the case, there's just a really strong case to be long physical commodities.
Yeah.
Silver, gold, platinum, basically anything that you can hold. If whilst the yield curve is showing signs that there is somewhat of an effective interest rate built in, it's going to take one comment from the Fed this evening to change that tone. And it's just really, really difficult to sort of understand where that will go. I personally still think that there's the reason to be long physical commodities, even if that does change the narrative somewhat, just because we've got this protection against trillions more stimulus coming online. But yeah, it's a really difficult situation. I would have thought silver and gold would have gone up a lot more in the last 6 months personally. I'm quite surprised. I've only recently started entering positions, so my P&L is close to zero for the time being.
Yeah.
We'll find out
in a couple of weeks.
Or potentially tomorrow.
Hopefully tomorrow. We'll have a good idea of what's happening next. Otherwise, we're going to have to wait another couple of months for the next podcast. In terms of those commodities, I mean, when I think of sort of the commodity side of inflation, I kind of can't help but wonder, iron ore. Here in Australia, massive pricing, one customer basically. Does that really, are we seeing that inflationary aspect really kicking in there as well, do you think?
Well, I think that should at least shield the Australian economy, but it hasn't necessarily translated into clear-cut inflation just yet. But that's been the case for a decade. I think that's what economists have been baffled about. It's not my area of expertise, but everyone's been looking for this inflation and haven't been necessarily able to find it in the traditional measures. But that's why when you're looking at some of the prices that certain assets are trading for, whether they're crypto, whether it's physical commodities, whether it's these new NFTs, that's where inflation now sits, in people's willingness to pay a seemingly incredulous amount of money for an asset that either didn't have a value previously or most people don't attribute that same value to.
So now we're basically looking at the idea of inflation is all around us, and it's really you've got to go looking for it as opposed to it being in the standard consumer price indexes or purchasing manager indexes that have been reliable in the past. Maybe perhaps instead of using those, we need almost a new basket.
Definitely. I think that, there we go.
That's the solution.
ACY CPI basket. The ACY.
The new inflation basket from ACY coming to you soon. Now, looking a little bit further, you mentioned NFTs, and I know a lot of people have been talking about NFTs. I don't know too much about them, but I do know a fraction, like that they're a non-fungible token, and that there is certainly potential for the people that were no coiners last time to perhaps get involved. What can you tell me about an NFT? Is it what is it? Let's start with what are they?
Sure. Yeah. So non-fungible tokens effectively mean that it is a token attributed or belonging to one specific asset. That asset could be a computer file. It could be a piece of art. It could be a video clip. It could literally be anything it wants to be. But what it means is that token is attributed to that specific piece of asset. It can't belong to anything else. We could switch Bitcoins with each other. We could switch $10 notes with each other. That's fungible because they've got the same value. It doesn't matter which one we hold. That's how society values that particular asset.
Yep.
With non-fungible assets, this is the original. It cannot be replicated. I own this video clip. I own this picture. I own this meme. I own this tweet. You can have an NFT on anything. That is literally why it's this now potentially limitless way of storing value and moving money around, and why I think there's so many more people starting to talk about it. While we saw this collage sell last week via Christie's for almost $70 million.
And it still went through the same sort of auction process you would expect from a Christie's auction as well. But when we look at that NFT side of thing, I mean, how are they really being used? They've been around for more than the last couple of weeks, because the music industry has used them for what feels like a decade, right? Like it's been since blockchain technology was first instrumented. It's ended up with the music industry using them to sort of get copyright ability on songs and tracks for artists. So
yeah.
So in that instance, how is that different to what we're actually seeing being used today? Because with the music side of things, it makes sense. And it makes sense to a lot of people that this is how we can maintain our copyright, so to speak, on this piece of music. But now it's moving into areas like memes and weird stuff that I'm not quite sure.
Well, yeah, I mean, if we categorize what we're at least seeing in the past few weeks, we're seeing a lot of video clips, a lot of highlight reels from the NBA trading for immense numbers, like hundreds of thousands, millions, just for a layup or a dunk or a buzzer beater. Now, whilst the numbers sound crazy, so do the numbers of some baseball and basketball trading cards.
Yep.
But that is also an asset. And these are effectively now the digital representation of people collecting moments that everyone remembers and everyone thinks fondly about. So I can see a case for why people would have an interest from a sporting side. When it comes to usability, absolutely. The winners are the artists, whether they're a singer, songwriter, whether they're an actual artist. Because the beauty of an NFT is you can build a royalty into the token itself. That means every time it trades, the artist gets X%. And this is the beauty of how it's going to get consumed in the future, because if you're an artist, you don't necessarily have to think about how do you maximize revenue at point one. You can think about what are people going to want, what are people going to like, what do I want to do? And then as long as there is a constant demand for that piece of artwork or that style, you're going to, over time, make money, and I see it being really, really heavily used in that space.
So how would you go about, I mean, I'm just thinking about it from some of the examples you said there. Like if we were looking at a video of the basketball dunk, right? Who gets the rights to that? Is it the guy who makes the dunk, or is it the NBA? Because that seems to, like, to me, that brings up issues of almost like regulation and infringement on someone's rights, and is that video still mine or is it someone else's now? Like, where does that sort of happen? And does that mean, like, okay, perhaps I could go and find, you know, going back to the old days with Cheese TV, put on an episode of Dragon Ball Z, turn it into an NFT, and then now I own that entire clip?
My understanding is that is the case. Now, the tricky thing becomes, how do you know if that NFT has already been generated elsewhere? If it's not a piece of art, if it's not a song, it's much more difficult to work out if it's an NFT of an NFT of an NFT.
Yeah.
You think you've got the genuine article, but maybe someone already created that identical piece of work, put an NFT on. If it's not all sitting on one database and it's not easily able to filter and sort, that will become difficult. I think over a decade, we're going to get to a situation where it's really easy to work out, is this the original NFT? At this moment in time, I think it's going to be a lot more tricky. So, which is why I wouldn't recommend people go out looking for really obscure, images or JPEGs or videos, because it's going to be very hard to prove that that was the original. Whereas with a piece of art, with a song, at least you've got that confidence that it belongs to the person who created it, who produced it. So I don't know entirely exactly how that can get validated at the moment.
It feels like there's probably going to be some legal problems coming up in the future. But it does, I mean, I suppose even then, from a music or an artwork sort of thing, you know, the original, if it's a digital piece, then fine, makes sense. But if you've done it with a cello or a paintbrush, then the original is really that one and not the digital variation. Does that mean you have to go and burn the piece of art straight after?
Well, so it's really that connection of that token. That token means this is your art. You own it. Or if it was a JPEG, you own the JPEG of that art. It really just matters of how that token has been described. So when you're purchasing it, you need to know what you're buying.
Okay.
Are you buying the picture of the picture? Are you buying the picture itself? Are you buying the music that was playing in the room when that picture was being shown? So it's just going to be a really abstract asset class, but it sits perfectly at a time when inflation is seemingly going up, at a time where people are looking to deploy money, and at a time when effectively, I won't look at the nefarious cases for NFTs, but there will be cases where there'll be some people who look to move money between countries, between certain interesting shell companies, because it's really difficult to say what is the true value of that asset versus a house or silver trading on an exchange. You know what that price is. With an NFT, there'll be a bit more opaqueness, a bit like how crypto started. It's become much more mainstream and much more accepted as not a bad use case and not a nefarious case, but I can see NFTs at the beginning used for some shady purposes.
Well, I mean, that's the whole, almost part of the entire origins of cryptocurrencies to begin with. That nefarious sort of purposes of, using it through Tor browsers to pay for whatever materials you may be wanting to get. And of course, the instances of being able to remain anonymous. Does that same anonymity apply to NFTs?
I believe it does. Again, we're so early in this journey. I've been reading as much as I can about it, but that is certainly one of the cases. The benefits of the NFT is the ability, from my understanding, to remain anonymous, I should say. But because it's important as well with an NFT to demonstrate that it's a genuine piece of work, there is probably some case where you do want people to know that you own this, so that someone can't go and replicate it. Because if you're not sort of making it publicly available that I am the owner of this, then someone can just easily go and make an NFT of an NFT, and until that database is better defined and how people know that you were the genuine article, there is a bit more of a case to want to attribute your name to certain pieces of work. I know I'd want people to know that I bought the $69 million collage, for example.
So you're the guy.
maybe the next. I think my bid was about 65, and then at the last second it got dimed.
So have you ever tried making any NFT art yourself?
Look, I've dabbled in making assets that I've thought people at times would have a use for, whether that be funny tweets and memes. No one's really taken the bait just yet. But there've been, I find, certain people in the Twitter sphere particularly entertaining, and ultimately those people are definitely now in a position where they're able to sell tweets. So even Elon overnight was joking that he was going to sell an NFT of his song about an NFT, and then I saw someone make an NFT about his song about an NFT. So it really comes back to this whole picture of a picture situation where you can have an asset on an asset on an asset, and in a really
like the Inception movie of assets.
Exactly. That's a very good description.
it's the closest resemblance that I could go, all right, within a dream, within a dream, within a dream. So,
I haven't done NFTs on Leo, though.
Maybe you should be the first, or perhaps I should be putting the Inception movie up. Now, who are sort of what are the major players sort of that are involved in NFT spaces right now? Are there certain exchanges that are involved that we need to be dealing with? Is it like a crypto wallet where you just kind of need to sign up to a crypto exchange? What's your understanding on that side?
Again, I think it is early stages from the sort of wider community. There are definitely some of the coin spots where you're able to effectively search for NFTs. I myself haven't done too much digging when it's come to the purchasing, but more just understanding the medium of exchange. It is certainly it's an interesting space in terms of working out exactly where you're going to be able to find all these NFTs. I think I'm probably going to spend the next couple of months myself as an exploratory phase, and we'll be able to come back with a better idea of exactly where that is.
I'll let you know when I turn this podcast into an NFT, and then you can make an NFT of the NFT.
Oh, I was going to put in a bid for the NFT.
Okay, well, we might start wrapping things up for this episode. We've got sort of 2 or 3 things to sort of think about first. Now, how do you foresee OPEC's story continuing?
I think OPEC is going to have to be particularly careful to rattle the price to the downside. I'm not too surprised about the fact that supply isn't just rampant at the moment. There are just so many writings on the wall when it comes to EV, when it comes to hydrogen, when it comes to ESG, and even SPACs which are able to invest in things that effectively counter the business case of oil. And until the world gets back to consuming more than 100 million barrels a day, there will be a period where oil can't just get up to 100, except if inflation runs rampant.
Okay.
So that really comes back to the sort of broader scale about where does inflation sit. There's a business case to be long oil from the same reason as there is to be long silver, just from the commodity side of it. But from an actual use case and how all of these various players are going to get the maximum out of their reserves, none of them want to push the price down just too quickly and ruin this particular moment in the oil cycle.
Okay, so that's pretty clearly defined in what we're looking for in that instance. From the Fed, do you expect them to remain dovish?
I think they're going to remain dovish as long as they possibly can. I think it's just really difficult for them. You've talked about Inception. I think of the scene in Chernobyl with the Fed and those graphite tips go into the reactor and the entire reactor explodes. And that's just made an entire TV series right there, that one moment. But ultimately, that's how interest rates feel at the moment. It's so precarious. This tiny move in yield curve, well, a big move in yields, but a tiny move in interest rates could really just reshape the entire global capitalism as we know it in the next couple of years. So everyone's waiting to see what is done. No one wants to pull the trigger anywhere. No one wants to switch off free money, but everyone knows that eventually something is going to have to happen.
Okay, so we're sitting in a sort of stance where they're going to try and remain to be as dovish as possible for as long as possible, but effectively they're going to be reacting as well to where inflation goes next. So we're all going to be watching, the elements of inflation and how quickly it either rallies or rises or spikes, and obviously the spikes aren't anywhere good for us either.
No, if inflation is there, it's going to be very hard for them to just bake in that that's optimistic inflation, as much as they'd love to say that, because if it's optimistic inflation, they can say, yeah, let the economy grow, let it be robust. But if it's a stimulated inflation, if it's just come from them printing money and assets going higher and creating more volatility and not necessarily solving any of the problems that we have, and the debt gets no smaller and there'll be more debt to service at a potentially one day higher interest rate, decisions are going to have to be made in the next year. They won't be able to just sit on their hands for the next 8-9 months.
And so I suppose that narrative, like you said before, the idea of inflation equaling optimism, from our experiences on the ground, I don't know, I'm not pretty confident about inflation. I don't know why the Fed is, sort of deal, right? So, how are they able to sort of propagate the idea of inflation is positive? But when you see so many traders and so many articles and so much discussion.
Well, when you look at just the house price index around the world, in Australia it's incredibly high. In the US, prices are also going up. Europe, I read an article about German house prices also going out of control. So really, it's a global problem now, the inflation. It's nowhere, no one can run from it, no one can hide from it. Ultimately, it's going to take central banks to have to make decisions that change the tone when it comes to yield curve. The fact they've got yield curve control at their disposal, I always think is an underused tool in the US. I think if you just talk your book a little bit, but continue to creep interest rates higher, you can effectively soften that potential shock that's coming. But at the moment, they don't want to do either.
So that concludes today's episode. Thank you very much again for joining us today, Daniel. It's been a pleasure having you on the program. Now, for those of you who might like to get in contact with either myself or Daniel, I will put up our details on the screen now so that you can get in contact with us. And of course, don't forget that we have ACY Securities and that there are plenty of services on offer for you to stay informed in current market updates and events. So please feel free to check out our website at acy.com.